Friends, in this class of financial management, we are taking up the second part of working capital management, and that second segment of working capital management, it is titled as Receivables Management. So basically, it is still about management of working capital, but now we are not focusing on the entire working capital management, but only one specific component of working capital, that is one specific type of current asset which we classify as receivables. Now what do we mean by receivables? When you are providing short-term credit, to your customer or any other party, that corresponding party or that customer then owes you something, correct? And in that case, whatever amount is payable by that person is an amount receivable by you, and that is what we call as receivables. And it is more commonly also known as debtors, and therefore receivables management, in many textbooks you will find that receivables management is titled typically as debtors management, and there is nothing wrong about it because you are indeed managing your debtors. But let me tell you, the right term would be receivables management. Why? Because when we say receivables, it includes debtors and it also includes bills receivable, because even bills receivables are part of your overall receivables. And I don't have to explain you what are bills receivables. You have learnt everything about bill of exchange at your foundation level itself. So let me explain what exactly is all about receivables management. So point is, you have sold goods or services on credit to your customers. In this competitive environment, providing goods or services on credit has become a trend. Why? Because you look into one thing, everyone is providing credit to their customers. If you are an entity into similar business and you are not providing that credit, what will happen? You will lose your customer. Let me give you an example. Suppose I am a computer parts dealer in Mumbai, and in this segment all the dealers in Mumbai, they are providing credit period of exactly 1 month. So you purchase a laptop or you purchase a desktop, you purchase all these computer parts, you will be given 1 month credit. That is the trend over here in this market. If I am into this business and if I don't follow that trend, that customer who could have purchased my product will not buy that product from me just because of me not providing that credit. So whether I am providing credit to the customer or not providing credit to the customer can make a big difference for the customer to take a decision whether the customer should purchase the product from my company or not. So here we are understanding one fact, that providing goods on credit could be a kind of trend which you will have to follow in today's competitive environment. And therefore the first segment in receivables management will be a very, very important segment of receivables management, that is analysis of credit policy. Now what is this credit policy? So whether I should provide credit to customer or not, I have to take a decision about my credit policy. Because if you come and ask me that, sir, what is your credit policy? I would say I am not providing any credit at all. That is my credit policy. Or I may say I provide 1 month credit to my customers. I may provide 3 months credit to my customer. That becomes my credit policy. Now, what is about analysis of credit policy? When I say analysis of credit policy, we have to look into what is the company's current credit policy and what other policy the company could have followed. For example, currently if I am making no credit sales, that means all sales I am having purely on cash basis. Do you know what will happen? If I am having all sales on cash basis, there is no debtor arising in my case. If there is no debtor or no receivables arising in my case, Actually, I don't have to manage receivables, correct? Because there are no receivables. What will I manage? So, somebody from my team is coming and putting forward a proposal that, sir, why don't we start selling goods on credit? We start providing credit of 1 month to our customers. Why don't we do that? I said, why should I do that? That person from my team says that, sir, everyone in the market is providing credit. If you also start providing that credit of 1 month, we can expect more sales. Now here comes a motive, that I have a motive that if I take this step, I have an expectation that there will be more sales. Mind it, it is merely an expectation, because we are at the stage of taking a decision. We don't know what will happen in reality. It may so happen in case of companies that they have extended the credit, they have started providing goods on credit, but there is not a pinch of difference in their sales. It is possible, correct? But here we are having expectations that if we start providing goods on credit for 1 month credit, maybe our sales increases. Now with that motive of increasing sales, that's a big positive plus point, because if sales increases, along with sales, variable cost will also increase. However, the component of fixed cost does not change. You know it very well, because whether I make less sales or more sales, the fixed cost remains fixed in totality. So variable cost will definitely vary with sales. So you know one thing, sales minus variable cost gives you contribution. With the increased sales, you will earn increased contribution. That is a plus point. That is a positive effect of extending the credit. However, there can be negative factors also when you are considering this decision. What could be negative factors? One biggest negative factor could be threat of bad debts. You know one thing, bad debts are such debts which are turning to be bad. Means I have given goods on credit to customers, those customers have become my debtors, and they have not made payment on time, they have not even made delayed payment, they have just simply not paid the money at all, and then I write off that debtors from my accounting records as a bad debt. So if I am not providing any goods on credit, there is no possibility of a bad debt. But if I am providing goods on credit, there is a possibility of bad debt. Again, these are expectations. So looking at the past trend, looking at trend happening with other companies, looking at what is the type of market we are selling our product into, and all these factors when you consider, you will estimate that there can be maybe 3% of total sales turning as bad debts, and then that bad debt is arising as a loss for you, provided you sell goods on credit. So your present policy is not to provide any goods on credit. Your proposed policy is to provide 1 month credit. In such case, what will happen? You provide credit, then only there is a possibility of bad debt, otherwise that bad debt will not arise. That means one negative factor of thinking of selling goods on credit could be bad debts. Another second negative factor could be your fund blocked. Let me give you an example over here. Consider this pen. Do you recall? I have been giving you examples of this pen and the business of buying and selling this pen, this kind of business conducted by me. I have been giving you these examples right from the point when we learned what? Basics of financial management. So I think some students would have even recalled what is the selling price of this pen. I am selling this pen for rupees 25 and I am buying this pen for rupees 20. Rupees 20 per unit is the variable cost and rupees 25 per unit is the sale price. I buy one pen for 20, I sell it for 25. If I am selling this pen on cash basis, what will happen? Customer will pay me 25. So I purchase this pen, I have blocked rupees 20 from my pocket, correct? Because I am purchasing my goods on cash, I am blocking my money. Money that is getting blocked from my pocket is rupees 20, and then This pen I am selling to my customer for rupees 25. I am thinking of earning a contribution margin of rupees 5 per unit. But if I provide this pen on a credit basis, my customer will not pay me rupees 25 now. My customer will pay me that rupees 25 after 1 month. For this 1 month of extended waiting period, my money gets blocked. Correct? The question is, how much money gets blocked? Someone would simply say that, sir, rupees 25 is getting blocked because I was supposed to receive 25, which I did not receive. It may be a right angle, but I am giving you a better angle to think. Why? Because I did not receive 25. If I would have received 25, what was that 25 comprising of? Rupees 20 towards the cost that I have incurred and rupees 5 as my contribution margin. Now use your common sense to make a sale of this 1 unit of pen. Correct? To make sale of this 1 unit of pen where cash is not coming in, debtors are arising in my books. 1 pen I sell on credit, I will pass an accounting entry, debtors account debit to sales by rupees 25 in my balance sheet. Debtors are arising by rupees 25. But let me tell you, to maintain a debtor balance of rupees 25 in my balance sheet, I repeat that line, to maintain a debtor's balance of rupees 25 in my balance sheet, I don't have to invest rupees 25, I have to invest only rupees 20. So you can use your simple common sense and imagine how much money did I spend from my pocket to create that debtor's balance of 25. Answer is not 25, I have invested only rupees 20. That money which I invested, from where did that money come from? That money came from some sources of fund, maybe equity capital, preference capital, debentures, bank borrowings, some source of fund. That source of fund is not freely available. That means if you are arranging funds, funds will never be freely available. Somebody might say that, sir, what if it is our own funds? Even your own funds cannot be freely available. We have learned this under the segment cost of capital. So let me tell you one brief thing as a reminder. You can arrange funds by maybe borrowing or arranging it anyway, and you will have to spend some money as cost towards that borrowing or arrangement of funds. That is what we call as cost of capital. If it is your own fund, suppose I have my own 20 rupees. I have my own 20 rupees with which I purchase this pen. I have my own 20 rupees with which I am purchasing this pen. Now, here someone might feel that I am not incurring any cost, but I am still incurring cost of funds. Why? That rupees 20, I had no intention to keep it idle. I could have invested that amount, maybe with a bank, and I could have earned 5% interest on that rupees 20. So 5% interest on that rupees 20, 5% of 20 is 1 rupee. I could have earned 1 rupee of interest on that money that I could have deposited. But if I am blocking that money in buying this pen, simple point is that money is getting blocked and I am losing an opportunity to earn that interest income, and therefore irrespective of any situation, if I am blocking my funds blockage will never happen freely. There will be interest cost that you have to consider for that. That interest cost could be the real outflow of money from my pocket, or it could be an opportunity cost of capital. Any situation, cost cannot be ignored. So the second component that arises as a negative factor could be cost of funds blocked. In this example, if I ask you to find the amount of fund blocked on this pen, if I am blocking this money for 1 year time, what will be the amount blocked? Amount blocked will be rupees 20, and what will be the cost of that funds blocked? The rate of return is given as 5%, 5% of that 20, that will be the cost of funds blocked. So cost of funds blocked, you will have to calculate based on the cost that you are incurring. Never calculate that on the basis of selling price, because the money that you have to arrange is to incur cost, not to create sales. money that you have to arrange is for incurring your cost, because for your outflows you are arranging money. Third negative component could be, initially if I am not making any sales on credit, I don't have to spend anything for collecting these monies from my debtors, because as a very important function of receivables management, apart from analysis of credit policy and other policies like discount policy, etc., we have one very important segment within receivables management that is titled as managing your collections, that is collection management. So just imagine, if I have given 1 month credit to my customers, throughout the month I will make sales. When I say 1 month credit, that doesn't mean that any date of January you purchase the goods, you will have to pay on 1st February. That is not the condition. That 1 month on individual basis for each customer will be counted as 1 month starting from the date of sale. If you have purchased goods on 5th of January, your 1 month completes on 5th of February. If you have purchased goods on 25th of January, 1 month completes on 25th of February. I hope you people are understanding one thing, that for each individual customer, their credit period will be counted from the date of sale, from the date the invoice has been raised by the company. Now, because there may be thousands and thousands of customers, and each day some or the other customer will come and purchase your goods on credit, don't you agree that you have to maintain systematic records for each customer? That means customer wise record of what is the date of sale and what is the expected due date, how much is the expected amount, and you have to start putting efforts and time for collecting this money from your debtors. Otherwise this amount will turn to be bad debts. There may be 15 to 20% good people who don't need reminders, they will come on their own and pay me. Maybe you as a person fall into that category, but majority people don't fall into that category. Someone would say, the company who has sold goods to me on credit, if that company is not asking money, why should I go and pay money? Because there is no penalty of delayed payment. In that case, if there is no penalty for delayed payment, why should I go and pay it from my side? Let them come and ask money. Then it is my role to play over here. If I am the company, if I am selling goods on credit, I have to manage my collection. If I am not selling any goods on credit, no collection charges were incurred, because I will not do everything myself, right? I will have staff appointed for making collections, and these collections management is therefore a very important function, and this collection management therefore also requires some cost to be incurred from my pocket. Cost incurred for collection of funds, which we can simply call as cost of collection, will yet be another outflow. So what you have to do, you have to sum up all your variable cost and fixed cost towards the product, which we can sum up as cost of goods sold, which is aggregate of both the components of cost, variable cost and fixed cost. One component of cost is cost of goods sold. Next component of cost could be collection charges, or you can have administrative cost in that category. So it is basically management cost, administration cost, or collection charges, or cost incurred for collection management. Whatever you title that as, it means one and the same. Third component could be the cost of funds blocked, and fourth component could be bad debts. These four components of cost you consider. From sales you subtract all these components of cost, and what you get is your net profit. Now what you have to do, currently you are making no credit sales, so your present credit policy is 0 credit period, and a proposed credit policy is providing 1 month credit. So you make a comparative profitability statement in 2 columns next to each other: particulars, present policy, and proposed policy. Then what you do is, when you have particulars, present policy, and proposed policy, you just try to identify all the components of revenue and cost, and finally figure out how much is your net benefit at the present policy and at the proposed policy. If present and proposed policy both are giving you different results, one thing that you have to identify, that if the proposed policy is enhancing your profitability, if it is enhancing the amount of net benefit that you could have earned, that becomes your point of decision. You will go ahead and say that yes, we accept this proposal of increasing the credit. Inversely, it may so happen that your present policy gives you more benefit. Then you would say, okay, fine, understood that by increasing the credit period or by providing goods on credit, we are having increased sales. But our objective is not just to increase sales, our ultimate objective is to increase the profit. If the profit is not increasing, we are not interested. Based on the outcome, purely on the basis of financial consideration, you are going to take your decision. So all these talks that I had with you, you will have better understanding when you take at least one small example in terms of identifying what you have to do and how you have to do when it comes to analysis of credit policy.